This accounting mini lecture video explores the cash and accrual basis of accounting. The first thing that I would like to mention about the cash and accrual basis of accounting is that under generally accepted accounting principles, the accrual basis is required. Therefore, you'll generally only see the cash basis used for very small organizations. For example, a small privately held business may be able to use the cash basis, but for large publicly traded organizations, they are required to use the accrual basis because that's what's required under generally accepted accounting principles. But in this video, we're going to examine both the accrual basis and the cash basis. And as we do, I think you'll start to get a better understanding of why the accrual basis tends to be advantageous from a financial reporting perspective. Under the accrual basis, we recognize revenues when we earn them, and we recognize expenses when we incur them. This allows us to adhere to the matching principle. The matching principle basically states that we want to match our expenses against the revenues they help to generate in order to obtain a more accurate picture of our true net income, our true profitability. Whereas under the cash basis, we simply recognize revenue when we receive cash and we recognize expense when we pay cash. Now, let's look at how this might impact a transaction. What we're going to do is we're going to look at a given transaction and we're going to examine how it would be recorded under both systems, okay? So here's our transaction. On December 1st, 2013, Fast Forward Company pays $2,400 cash for a 24-month business insurance policy. Now, if we were using the cash basis, we would expense the entire $2,400 as insurance expense on December 1st when we pay the cash. Therefore, we would recognize no expense related to this insurance policy in 2014 or 2015, which are clearly covered under the policy as it spans a full 2 years. So that's how we would treat the entry under the cash basis. We would basically, on December 1st, 2013, we would debit insurance expense for $2,400 and we would credit cash for $2,400. Now, let's examine how we would record this entry under the accrual basis. Under the accrual basis, remember, we're going to recognize revenues as we earn them and expenses as we incur them. Under the accrual basis, we would match this expense across the periods that it's going to benefit. So what we would do on December 1st, when we pay the $2,400, we would debit prepaid insurance, which is an asset account, and we would credit cash. Then at the end of each month, we would record $100 of insurance expense. We would do this by debiting insurance expense for $100 and crediting prepaid insurance for $100. And what this allows us to do is match that insurance expense that's covering each month against the revenues that are generated for each of those months. And this is the basic principle of the accrual basis of accounting. We want to match our revenues and expenses to get a more accurate picture of our net income. Thank you for watching this video on the cash and accrual basis of accounting.